Hello, welcome to smarthelping.com here, and we have a new real estate model. It's a little bit different than what I've normally done in the past. Basically, all the assumptions are right here on the model tab. It's for doing pretty quick analysis on a unit-based acquisition. So here, I'll just go through each section and how it works. Um, the first section is initial debt, initial cost, debt, construction. So here you can enter the property purchase price, any closing costs. That cash flow item is here. Everything will aggregate at the bottom to show a final cash flow detail as well as net operating income. Initial cost, you've also got any debt uh, or proceeds you want to do with the purchase. If you're going to borrow some money, you can put the terms in there. The repayment month, the amortization, annual interest rate, payments per year, and amount. And that'll show up right here. You can adjust this to anything. For example, say I wanted a 20-year term and I was only borrowing, less, like 350,000. That'll all flow through the whole model accordingly. Repayment and or exit month. So on this month, you would define, let's say if it was 60, then I'd go from a 10-year model to a 5-year, and you can see after that month everything stops. So there I just stopped at 160. There's exit value that'll populate. We'll get to that in a second. So that kind of drives the length of the template, and whatever end month you select here, the debt will be repaid, whatever balance is left, and the based on the annualized net operating income, we'll get a valuation based on this exit cap, and that'll flow through. Put this back to 120. Then we've got construction. So this is kind of a nice little logical structure here where you can enter the total construction cost you think you're going to have, if any, and the start and end month of that construction, and this will just evenly spread out that cash flow based on the month numbers up here and what you define right here. So I could put this as, what if construction is month 1 to 8? You can see it evens out. What if it was, 400,000? It evenly will spread that out. Next up, so this is one of the more unique parts. We've got rental detail, and here you've got up to 10 units. You don't have to use all 10. You could use any 1 to 10. You can define the initial square footage and the annual rent per square foot, and based on that, you'll get a expected monthly rent as well as a rent per square foot per month. You can also define the start month that this rent happens for each unit. And the months here, and this is kind of a unique thing I've done, and I think it's pretty nice to it's easier than selecting months, so I kind of like it. You just put, month one is always the first month. Whatever you select here is the first date, and it goes +1 every column over, or every period. So here you just define, well, what period is rent starting for each of these units. Now you can also do. So this is like if you're doing construction, you might have some of these have rent, some of them you're waiting, so you can define how that works. Also, you might be charging initial rent, and then at some point in the future, you want to raise the rent, maybe when the construction's done or for whatever reason. You can put in the new rent per square foot annual rent per square foot. The start month of when that happens. So here we put in month 8, so you can see month 8 the rent goes from 1,400 to 2,900 for each one of these, and you could define different numbers for all these. Like I could stagger it, 2, 3, 4, 5. You see all this updates. This is the total unit live count up here, which is going to be used for expenses. I'll get to that in a minute. Also, this start month can be dynamic as well. Let's say 4, 5, 6, 7, 12, 15. Maybe these never start. If you never want to go to the secondary thing, you can just enter a number that's like 1,000. And then in that case, like these bottom 4, in this case, would just never go up from whatever this initial rent is. They would just stay the same the whole time. Put this back to 8. And then finally, we've got annual increase in rent. So this is only once this has started, rent starts going up. If you never have this initial increase or change, then the rent will just stay at whatever it was at the initial amount, whatever you're defining here, whatever that might be. This is just some logic to show how this is the rent increases in each period. This is to figure out the right month number to get the increase. And you can see the age is used here against this table to figure out rent increase over time as well as expenses, which will be defined down here. So now at this point we have all of our debt, construction, initial purchase price, all the rent. So we have total revenues. Now we want the total expense details. So you can put an increase in annual, increase in expenses. You can put the amounts here. The only one that's not per unit is the first, which is property taxes. So this will take, $4,000 per year. That's assuming for the whole entire, all the units combined, and that's just going to be divided by 12. And then that will also increase by the expense percentage. So you can see here we get up to 398, starting at 333. Now these are all editable. Put these in light yellow and blue text, and it's per unit per year. So this is saying for commercial and fire policies, each unit it's $500 a year. Repair and maintenance, $500 a year per unit, etc. And you can update these to whatever makes sense for your buildings or specific units. And then the calculation here will take the amount of active units. So that's where this is coming in. And it'll take the amount of active units times this amount divided by 12, since this is an annual amount we're showing monthly here. So you can see the expenses are super dynamic. And then now that we have revenue and expenses, we have net operating income going across here, which is just taking the total revenue minus the total expenses. We have exit value, which is going to take the annualized net operating income divided by the exit cap rate to get the exit value. And that's just displayed over the whole time. The only cash time this hits cash flow is on whatever month you define up here in D16. So we got net operating income valuation. Then this is the cash flow detail. Oh, and note selling fees here. So if you on the exit proceeds, you might have some fees that you're going to account for. So that's, and I put these right in with their cash flow line items. So cash flow detail is looking at net operating income, and then all the different other things that affect cash flow. So you've got the loan proceeds coming in, you've got exit value, less selling fees, and you've got purchase cost as a cash out, construction costs are cash out, and debt service is cash out. So here you can aggregate all this and figure out here's my cash balance over time. Then row 111 is equity contribution, and I've just defaulted this to take any negative value and populate it here so that the cash balance after equity is never negative. Now you could override this if you want to put it all up front or have maybe 3 payments or however. This is just defaulted to when the actual negative cash flow happens in a month. That's when the cash is needed. So this will default so cash balance never goes below 0. And then you got equity balance. This is the total funds contributed. And the minimum equity required 1.2 million is just taking the net the minimum value from the cash balance before equity. So it's a really good, nice model. Shows a monthly detail. What I've done here also is added an annual summary. So this is the same detail I just went over, but on an annual basis for everything. And we can see cash flow here on an annual basis. Some sanity checks. Note that I added a sponsor investor detail because on the cash flow waterfall, you can define how much of the equity that's being required right here based on all the different activities that are happening. You can mark how much of that comes from investors versus sponsors, or it could be all investor, all sponsor. You can define that with percentages very easily. And then based on that, we've got, a nice waterfall here. You could define percentages so this is with hurdles, and it says if an LP has gotten a certain internal rate of return, then you go up and the sponsor gets more and more as the investor gets better return, as the investor's returns improve. So you can define what the investor contributes versus the sponsor, and then how those returns, how the cash flow is being split as the total return for the investor changes over time based on what cash flows are available. So it shows you a nice detail for each tier here, and then you've got total cash flows, LP and GP. And this is nice. You can set up like a preferred return hard pref if you want to do like 100%. Here on the first hurdle, that means that until the investor gets 10%, they get all the cash flows, even if the GP had contributed some. Or you could set it pari passu, which would then be 80-20 match. It matches the contributions here, and then the GP is getting promoted as the returns improve. I also did this kind of cash flow analysis based on these numbers coming through. You could just plug in your discount rate for sponsor and investor and see the net present value. You've also, note this is on a monthly basis, so I had to convert these annual hurdle rates to monthly to do the checks. So you can see the preferred return monthly is using it's taking the internal rate of return and putting it into a monthly hurdle. So this is checking if the monthly hurdle has been reached, and if so, here in this case, 10% is not reached until, month 79, and then we get to tier 2. So you see here, that's tier 2, and then we go on tier 2 cash flow splits, and then we get to tier 3 in June of 2030, and then finally at the exit, you get to the final hurdle, which is 50-50. Now you can define these hurdle rates whatever you want. You could define these splits at whatever you want, depending on how you're setting up the contract and the deal and negotiating. But really cool stuff here. All the logic's really nice and checked. It all works nicely based on whatever you put in here. I also did some visualizations, cash contribution distributions per period, monthly net operating income, annual net operating income, exit value per the exit cap rate, and then annual cash flow detail, which is showing that cash flow detail basically just visually in a running cash balance. Loan tab is just amortization based on that first loan part in the beginning of the model tab. All right, that's it. I think this is a great real estate model. It's a little bit of a different approach, but if you're doing like smaller unit-based acquisitions, it's a really good quick model to do. This will be a $45 one-time cost for this. Link in the description box below. It'll be at smarthelpyou.com. It will be in all the real estate bundles as well that I have. So don't forget to subscribe to the channel. Also put it on some vendor sites for templates, probably Eloquent, eFinance models. And that's it. Have a good one.